attending this webinar. I am Captain Gaurav Rana, and I run C and Beyond. I'll be your host, and we have Saurabh, an ex-mariner, Shelfica, Anchal from Sparklehood team, and of course Captain Yashovarman Sharma, whom I'm sure we all of us know. So, so a very warm welcome to all of you. Uh, Anchal, if you can move to the next. There's one before this. Right. So just a quick reminder on the best practices. Speaking rights are given to the host and the presenters. Typically, the attendees communicate through the chat window, wherein we have exchanged greetings, or through the Q&A. There's a Q&A button wherein you can write your questions. And before writing a question, go through the earlier questions as well. There is a possibility that your question might be there, so you can just give a thumbs up to it, and it will, and so we know most persons have the same question. So those are the two ways of communicating. If you would want to speak, then you may have to raise your hand, and we might accordingly give you the rights to speak. um, in a lot of cases, when we enter, the name of the phone or the laptop shows in front of your name. So maybe you would just want to do a right click and rename yourselves to your actual name. So that will help us to communicate better whenever the questions or in a chat window that comes through. On the questions that you might have, if you do not understand or you have a question on the slide which has been presented, you can put it there in the Q&A section. The questions will, you can keep on putting the questions, but we will take the question at the end once the presentation finishes. But the only request is if you can put the questions related to the slide which is just been presented across to you. Focus is on you, and so very specific questions we can take one-on-one at a later stage. Generic questions is what we would essentially take. Slides will be shared with you on an email, and we request you to keep a pen, pencil, and paper ready for the evaluation exercise, which would come through at a later stage for you. Next slide, please. Next slide. Uh, yeah, the earlier one, right? So why am I doing? We are doing this webinar. A year or so back, Anchal sent an email on our alum group about Sparklehood, and which is essentially a startup school for working professionals and helps early stage entrepreneurs build their ventures. I was working in IBM at that point of time and running C and Beyond at the same time, and I thought, wow, it's a great concept and something which I could get help from, or it could contribute, or I could contribute since I'd been running C and Beyond for the past 4 years as well. And then I thought about our maritime fraternity. We guys sailing on board ships, and sometime or the other, or a lot of times, at least I did during my sailing days, we discuss about going back and starting our own thing, another way of means of earning, or to be independent as such. Some of us do try, some do not, and some who try may succeed, may not. But the key point over here being, when we have these discussions on board the ship, and when we want to actually implement it, our ideas, when we come ashore, do we know the opportunities which are available? Do we know how to evaluate these opportunities? The best practices while starting our business, the key issues, the contractual issues, the legal issues, and then on all those things. And that's when I thought Sparklehood could be really beneficial to our fraternity, essentially in two ways. One, by assisting to start our own business. And second, by investment into other businesses. And in this session, we are focusing on the second one, which is investment onto the other businesses. And why I feel this is relevant for us is because when we are on leave, and all, which is at least 2 3 months, maybe 6 8 months also for some persons, we have time to study, we have time to evaluate, or maybe support a business which we would want to invest into. Many of us are looking for fair opportunities to invest our hard-earned money as well, and we have the fundamental skills, the aptitude, the holistic overview, the due diligence that we do, fairly end goal oriented. Of course, we need to do polish on our skills as such. We need to enhance them as well. So the idea is, through this session, Anchal, if you can go to the next one. I would essentially, we would essentially like to enhance your awareness. Um, um, yeah, we would like to enhance your awareness so that you can have a consolidated information from the credible sources, which are the presentators who are on our panel today, and which can help you to evaluate the relevance of the information so that you can take well-informed decision. So at the end goal is, you need to have all the dope needed so that you can take a well-informed decision. Uh, and in helping that, Anshul, to the next one, we have the presenters with us. We have Anchal,
Hi
who
everyone.
is the who's a serial entrepreneur and a co-founder at Sparklehood. He's got enough and more awards. A few of them is he was selected in the Y Combinator, and he got a SUS 2019 award in 2019. He got an award in IMA, the GC Mittal Entrepreneurship Award, and he has an experience of an exit from his previous startup. Captain Sharma, I don't think he needs introduction in our fraternity, but and 4 points are very less to kind of introduce him. But he's the director. He's running his own thing for True North Competence Management. He's the director over there. He's been a pioneer in maritime training from IMTC days, and of course a lot of training was focused to the marine sector, but he's also now he's also done training for aviation, and yesterday we were having a word, and he was training in the or he was coaching the guys from the railway institute as well. He's a fellow of the Nautical Institute and Company of Master Mariners, and he's been a member of various committees constituted by DG Shipping, Government of India, and various administrative bodies. We've got Shelfica, 3 years of global investing experience across PE firms at DE Shaw and Kingfish Group. She's graduated with the gold medal from IIM Indore in 2018, and CFA level 3 candidate. And again, one of our own, Saurabh, passed out from DMET, went to sailing, then he did his MBA from IIT. He's a partner at Sparklehood. After doing his MBA, he started working in companies, and he's worked in investment banking. He's worked in manufacturing. He had his own startup called Jiffy Homes, which was also part of Y Combinator. So yeah, that's the introduction about the presenters. Let me also take a quick poll on a high level introduction for the attendees as well. So I have a poll on what is your rank, whether you've been sailing, top 4 operational level sailing, have you settled ashore, or you have never went to sea. We know it's a fairly distinguished audience that we have. A lot of persons in the top 4, and a lot of guys, a lot of persons who have settled ashore, a lot of directors, founders, VPs in various marine related companies. Uh, got about 90% of you who have voted. Can I have a few more votes, please? Nevertheless, let me share the results for this with you so that you know what kind of audience we have. So we got about 45% of top four audience who are sailing on the ship as top four. 36% of us have are settled ashore, and about 9% sailing and 10% never went to sea. So that's the audience which we have, and thank you everyone for coming in. Really, it's a pleasure to host you, and so glad to have you over here. Over to you, Saurabh.
So I think there is something wrong with the presentation, or Anchal is not here. Is it? Anchal, we cannot see the presentation.
Okay, we can.
Yeah. Yes. So we move to the next slide.
For the next one, please.
Yeah. Hi, everyone. So I believe all of us in today's time have heard about startups and hear about it every now and then from somewhere or the other. The one of the questions is what is startup and how do we look at it? So primarily, a startup is a company which works on solving a problem whose solution is not very clear and the success is not guaranteed. So the question comes, do we mean that, let's say I open a bakery shop tomorrow, is that not a startup? Well, technically, yes, it is a startup, but from the perspective of investment, it will not be considered as a startup. And why, for the specifically, why the reason why I'm saying that is something which we'll see in the future courses. On the surface, I'll say is that startup primarily, when we talk about startup, which we are specifically talking of startups which tentatively will show a huge growth over a short period of time. Uh, yeah. So moving to the next slide. So when we talk about investments in startup, as in particularly angel investments or any kind of investments, what is it happening? Why do we invest into that startup? So the idea is when we invest into that startup, primarily in form of capital, we get a equity in return. What do we mean by equity? So in normal parlance, we say shares or a partial ownership of that particular startup in which we have invested. The other kind of contribution as an angel investor can be in terms of maybe connecting to, maybe providing your connects or similar sort of support. But the primary objective is providing the capital for the startup to grow. Yeah. So typically, what are the investment cycles? When we talk about investing in the startup, where do we stand at what, when does the investments happen? So primarily, an entrepreneurship journey starts with the pre-seed round, where what is typically happening is that, let's say, I think that this is a particular idea which does have a potential into the market. So I go start the company and start the project with few money arranged from myself or my friends and family. So that is typically called a pre-seed round. The idea is that you experiment around a particular problem which you are thinking that this is the startup is about. Usually the money which you arrange from your friends and family or through your sources is around 50 lakhs. Once you have established that yes, there is a basic market for the startup which you have started, you go into seed investment. when we say seed investment, what we are typically saying is that on the premise, on the basis that you have got a few early maybe customers, or maybe your product is ready, you reach out to different investors whom you show what you have done, and on the basis of that you expect the angel investors, as we call them, but primarily the investors, to put in certain amount of money into your startup. What is the use of that money? The use of that money is to kind of establish the assumptions which were on which the startup has been started. The usual investments ranges somewhere around 50 lakhs to 6 crores over a period of time, usually around 1.5 years. Once the startup, after raising the investment amount from the angel investors, establishes the concepts, as in they have shown that yes, this is how things work, and this is how my specific or our specific idea is working. Thereafter, they reach out to institutional investors. These institutional investors, when I say institutional investors, these are larger firms who specifically invest into startups of a larger amount. So these investors usually invest somewhere around 6 crores to as high as 700 crores. And there are different ranges, as in you raise series A, then B, then C. As the startup grows, as the company grows, there are further investments which keep on happening into the company. The conclusion of any startup can be, the ideal conclusion of any startup after raising funds is an IPO. This is the ideal stage where you list on a stock exchange, maybe Indian Stock Exchange or anywhere else, and you become a public company. One of the other alternatives is that ultimately you get acquired either through a competitor or maybe a strategic investor. Now, these three specifically, which we have marked in red, are the primarily liquidity events. What are liquidity events? Liquidity events are where the earlier investors, the angel investors, as well as the friends and family who have invested into the company, mostly get an exit, as in they get their money back along with the returns, which might be X multiple of the whatever they had invested. So we'll move to the next slide from here.
I'll take a poll over here.
Yes.
Yep, the poll is on. Where would you typically want to invest money? Steady and conservative returns, high risk, high returns, high risk, where I have control. High returns, high risk, doesn't matter on the control. Wherever a trusted advisor tells me to. So this is just to understand the the investment appetite for our audience. Yep. Looking forward to a few more answers. We've got about 87% of you, about 75 odd persons who have voted till now. Kevin, if you can answer on the poll, please. Okay, it's been a minute. Let me end the poll and share results. So yes, it's most of us, we would like to have high returns, high risk, where we have control. So 66% of us would want to do that. And I think the rest three options are almost equally shared. So, right, I think you're at the right place. Stop sharing.
So, yeah. So, obviously, we are saying that we want a high risk, high return. So, startups by default are a very risky proposition. Means if we give a comparison, so fixed deposits are the least risky proposition, lesser than mutual funds, then stocks, startup investments. The other investments in terms of real estate would lie somewhere around mutual funds per se in terms of the increment in the capital and so on and so forth. Why are startup investment risky? Why do we consider them risky? Primarily, we consider them risky because only 10% of the startups succeed. As we discussed earlier also, and as we mentioned, that the solution is not known. It's ultimately an experiment which is being done. And in most of the cases, and this is not something which has happened recently, this is across the years wherever we see startups are not something new. It is in trend right now, but this is something which has been going on since ages now, centuries, I would say. So typically, around 0.5% of these startups are those which give a tremendous response. For say around 7% startups give a average around maybe uh, around 10x, 5x to 10x return. So typically startup investments are risky and the returns are huge only in exceptional cases, not in a very general case. So that is the particularly risk. Now consider what are the rewards. So primarily one of the reward is portfolio diversification. When we say portfolio diversification, I'm sure that each one of us have invested certain amount in go maybe stocks, mutual funds, real estate. These are the usual investments which as uh, mariners we usually do. So the point is, why does startup investment make sense? Startup investment makes sense because one or two extraordinary results will give you that particular supernormal profits, as we say. And as we all know that yes, having your asset into multiple portfolios always diversifies your risk and makes things as a portfolio better for you. So to the next slide. Obviously, one of the primary other reasons is entrepreneurial community. As in, we all understand that startup, running a startup or running any venture of your own is very hard. And we all need to support these people. So obviously, supporting entrepreneurs helps us in innovation and creates a sense of growth in terms of the community as a whole, rather than as an individual and rather than as a group. It helps the growth of the entire community. And obviously, one of the biggest reasons we, as you all also said, the reason why we invest into the startup is the returns. So the next slide. There was one slide before this. Yeah. So returns, obviously, the investment into the startups provide you an abnormal profit over a period of time. And to typically show what kind of returns we do have, I'll show that with the next graph, which is in the next slide, where we typically see what are the kind of returns which we get. So if you see here, what we are denoting here, if we think that stock returns were huge, look at this graph. Lately, what has happened is that the return, the red indicates the return which you get if you have invested into any company after the listing, whereas the blue part represents the returns which you get as an angel investor had you made an investment into any company before their IPO. So primarily we are saying either as an angel investor or during the series A to E. This was the trend has increased a lot in the later stages, as you see after 2004 onwards, primarily because most of the companies today stay private for a much longer period. Like we talk about companies like Flipkart in the present scenario, there is a lot of question is that why do such companies do not go and list themselves? So one of the primary reasons for this is that these companies try to maximize the return for the initial set of investors and the whomsoever have invested to achieve the full growth of the potential of the startup. And once that full potential is achieved, thereafter these companies go and list on any of these stock exchanges. So this ensures that the initial investors, the angel investors, and thereafter the series investors capture maximum return from their investments rather than the shareholders who invest in the company after the listing. So now post this, we will again have a poll.
Yes. So the poll
So
is: do
we
you
want to answer.
have any prior experience of investing in a business venture? No, you would want to. Never thought of it. You've given loans to friend and family to support them, and maybe you have invested your money and time into a venture. Wait for another 10 seconds for the remaining 10% of you to vote. Okay, I'm closing the poll and sharing results. So, as expected, most of you do not have a experience of investing, but you would want to. And then there are also persons who are actually actively investing their time and money into the venture, about 20% of you, and some have not thought, and about for 17% have not thought, and maybe 17% of you have given loans to your friend and family. Yep. All right,
So
thanks.
now we shall talk about what are the skills required for deciding upon or making an investment, angel investment in particular. So I'll ask Anchal to take it over from here and talk about that particular thing.
All right, everyone, really excited to be here with you on a fantastic Saturday. So what is an investment thesis, right? It's basically like your personal investment strategy based on your research and analysis. Now, it could be very broad. It could be a contrarian concept, which nobody else in the market believes in. You might evolve it with the macro trends in the market. Why do you need it? You need it because it's your game plan. It allows you to stay disciplined, focused, concentrated on your investment objectives. Everyone investment objectives are very different, right? And then you also need to, when you have an investment strategy, you know what kind of companies, in what space, in what sector, at what stage, in what geography, which ones you want to do. And there might be some things which you might want to avoid. For example, let's say, I don't know, some people might think that, okay, crypto is too volatile. I don't understand that, so I will stay away from it. So you form your own thesis, which is your game plan, and then it allows you to also present or position yourself in front of the founders that you are the right investor for a particular segment. I don't know, someone could be, let's say, very focused on agri-tech. Someone could be really very focused on IoT, AI. Someone could be really focused on marine. So you develop that focus, and different people have different strategies. There's no right answer, but it has to be backed by your research and why you think it is correct, right? And then you need access to quality deal flow from other investors. So that also happens when you have a very clear cut investment thesis, Everyone else also knows that, okay, this person or this investor stands for this. Now, this is broad investment thesis, but of course, then when it comes to actual investing, you'll be looking at one startup at a time, right? In that case, your broad investment thesis allows you to kind of form your deal flow where you have multiple startups coming into you. Then you evaluate individual deals one at a time. Now, there comes the question that how do you evaluate these individual startups or businesses? Because most likely they will be at an early stage. Initially, when Saurabh showed the cycle, the investment cycle, the typical angel investment generally happens at seed stage or pre-series A, so before series A. There are some data points and metrics, but it's not absolutely clear. So some of the good things that you would want to look for is, okay, like how's the team? Does the founder have a very strong understanding of the industry, deep knowledge, expertise, skill set? Do they have complementary skill sets? Do the co-founders have complementary skill sets to balance out each other? How much trust do they have? How long they have known each other? I mean, these things might vary from different to different startups. Some of them, I mean, might be people who are like friends, who have known each other for 5 or 10 years. Some of them might be who have just professionally come together right now. But you will evaluate them on multiple axes. So one is the team part. Then you will look at the business metrics part. How is the engagement metrics? If it's an app where they're not charging as much, then engagement metrics is extremely important. Like generally, let's say, for example, there's something called DAU, a daily active user, and a MAU, monthly active user. So a ratio of a DAU upon MAU of greater than 20% is considered to be decent. So some of these things you need to know, right? Customer metrics. So for SaaS companies, for example, they have something called lifetime customer value, and there's a way to calculate it, and the startup or the founder will tell you. Then there is a customer acquisition cost. So LTV upon a CAC ratio, a customer acquisition ratio, if it is 4:1, it is generally considered to be high. So you need to, depending on which sectors you're focusing on, there are some common standard benchmarks which you need to know that, okay, if they're kind of like healthy in those areas or not. So you need to develop that understanding, and it kind of connects to the investment thesis as well. When you do a very detailed research, you start speaking to a lot of startups, you start speaking to other investors, you get to know these things more clearly. And the general press or the news that you get, it's always like a lagging news, right? When it comes to the market or the media, it kind of means that it's already late. So you get more upfront news when you are a little bit active in the space or well connected with other investors. Risk appetite, of course, if only 10% of the startups are succeeding, if I'm really smart, maybe I could stretch it to 30, 40, 50%. But then it all boils down to like a focus and playing with discipline. And even after all of that, we think that if you invest, you should invest from the perspective that, okay, if I do end up losing 50% or a lot of my portfolio, which I've invested in the startups, it's not going to break my back. I mean, I have still decent cash flow, and my family and other things are kind of taken care of. So you don't go, I don't know, overly optimistic and invest like 100% of your portfolio in just startups. That is, I think, what we're trying to say. Okay, I will hand it over to Shelfica now. So we have a few very exciting and interesting interactive exercises for you to get a flavor of how this evaluation might look like in real life. Over to you, Shelfica.
Thanks, Anjal. Hi, everybody. Excited to connect with you and really appreciate all of you taking the time today. So like Anshul said, the idea now is once you've sort of heard a brief framework and theoretical concepts behind angel investing, wanted to also give all of you exposure to some sort of practical or real life examples or exercises to give you a flavor of what this process really looks like. So we'll do a bunch of interactive exercises just now. The first one would be an example of a real life case study of a startup. And the idea behind this is to basically explain how to evaluate a business, or if you were exposed to a startup tomorrow that, hey, would you invest in XYZ? How do you go about the exercise of figuring whether or not this is the right for you? So basically putting down some sort of a broad assessment framework for startups. So in this case, we'll be looking at a startup called Zasket. It's, Anshul, can you go to the next slide? It's an online affordable supermarket. So think of it similar to a big basket, but slightly positioned differently because there is a strong focus on affordable or cheap or relatively lower priced groceries available to the mass audiences. And this is a real life startup. This is an actual startup that was founded later last year and is a part of the Sparklehood cohort as well. So the question now for you would be that this is basically all that you know about the business at this point. And I think this is a good time for you to take the pen and paper out that Gaurav had asked you to keep handy at the beginning of the presentation. And let's say if today I tell you that, hey, we know a business, Zasket. It's an online affordable supermarket. What it does is it provides free home delivery for grocery items, and it promises that it's doing it at the minimum possible prices. So this is all you know about the business at this point. It's an app-based software. And now the question for you would be, what sort of questions should you be asking before you invest in it? And we'll give you like 30 seconds or so. And maybe it's a good time to jot down some of those questions that, hey, if someone comes to me with a business like this, before investing, what questions should I ask? Sure. So here's basically some of the questions that we would recommend. Let's see if they were in line with what your intuition was when we sort of presented the previous slide to you. So the first question should be, okay, what is the problem statement or market gap that this company or this business is addressing? Essentially, is there even a need for a business like this? What is the market missing, and why does the market really need something like this? The second is sort of answering whether or not this business is a good solution to that problem. That, okay, this was the problem we saw in the market, and is Zasket able to address or answer that? The third question you should probably be asking is, okay, who is the target market? Who is their end customer? Who are the people who will actually use this service or this product? The fourth question you should be asking is around the unit economics. So said differently, basically thinking about how the business would make money on every unit or every product or in this case, every sale that they make. So essentially thinking about the profitability metrics, how are they creating revenue? What are their costs? Do those economics make sense? The fifth is around current traction, that, okay, they were founded later last year. Have they had any business yet? Have they been able to grow? Have they been able to, gain a few or acquire a few customers already? Do they have a supply chain in place? So basically just getting a sense of what the traction or engagement has looked like so far. Next, of course, a competitive advantage. Are there like other players in the space who are doing something similar? Is there anything that a company like Zasket is doing differently? Are there other players who could take over their market? What is really their strength or advantage as opposed to those other companies? The seventh, of course, is the potential risks. You should always be thinking about what risks does this company face? Are those risks strong enough or do not have enough mitigants to offset those? Or are there mitigants that make me feel comfortable about the risks? So the risk analysis is obviously always helpful for any investment thesis. And then one of the more important ones is about founder background. Are they a good fit for the business? Are their backgrounds in line with the industry? Do they come from backgrounds that I think will add value to an industry or a business like this? So here's what you should be asking. And I'll share the answers for these questions in the context of Zasket in the next slide. And then maybe we can try and collectively evaluate whether or not you would be interested in investing in a company like this. So here's for Zasket. So the problem statement or market gap in this case is basically lack of low price solutions for online groceries. So currently you can buy groceries online, but you have to pay some sort of a premium, you have to pay a delivery fee, and that is basically the problem statement or the market gap that Zasket is trying to address. The solution that it's offering is basically lifetime free delivery. So they're saying that it's not like only when you first join the app will give you free deliveries, will give you a permanent free delivery access on all products, and there will be no premium charged on grocery items. So basically addressing market for those people who, yes, let's say not used to paying a premium on vegetables or are used to buying those from street vendors and want a matching price from online solutions as well. And that's why the target market essentially becomes the mass market and not restricted to the premium market alone, who would typically be more willing to pay a premium for the convenience or the ease. The market opportunity, so we did a market sizing for the broader online grocery market. At this point, it's $2.5 billion in India, and it's expected to grow to about $8.7 billion by next year itself. So super fast growing market. The expectation is that, especially with the strong movement towards virtual worlds or strong movement towards people getting more comfortable with ordering things online over the last year or so, the growth is expedited, and there is an expectation that the market size will increase meaningfully by next year. The traction for this company. So they launched in November 2020, and by April 2021, they had already touched 100 orders per day, and they were making a monthly revenue of 10.5 lakhs. So it shows that they already have some customers or some initial engagement over the past 6 months and have already been able to gain some market. In terms of competitive advantage, so basically their competitive advantage is the way they've structured their supply chain. They basically operate on a zero inventory model. So they don't store any perishable items for long, believe in zero wastage, basically cutting down the cost of stock holding or inventory management. And that, they believe, is their competitive advantage, because of which they'll be able to potentially outperform their competitors. The risks, I think the first risk is non-premium positioning. There is a potential risk that because of the mass positioning, they might not be able to gain enough trust, or their product quality might be questioned. The second is, of course, the competition from online larger platforms like Amazon, or what we can call the Amazon risk. Basically through their Amazon Pantry and other initiatives, providing similar services potentially at a lower cost. So that's, again, a meaningful risk. So that was sort of like a brief summary in order to give you some optics or visibility into what the revenue growth has really looked like. The way you should look at this graph is that from November 2020 to April 21, they've had roughly a 40% month-on-month growth. And the green bars that you see in between, that's basically their recurring revenue or the repeat orders from the same customers. So of the 10.5 lakhs of revenue in April, about 7 lakhs was from their previous customers, which is basically implying that almost all their customers are going ahead and becoming repeat customers, sort of showing some sort of credibility. And the last point I'd touch would be around the founders. So that's always like an important question before you invest in any given company. So for this case, they have 3 founders. The founder and the CEO is an ex-Amazon and Swiggy employee, comes with strong e-commerce or marketplace sort of a background. All of them are BITS alumni, so come with like a default strong tech background. The second co-founder, he's a former ex-Bharat Petroleum employee, and he does a very strong value add in terms of operations and offline marketing. And the third is an ex-Yup TV, which gives them sort of like a broader exposure to digital marketing or product development. So this is basically all the context that we can share with you sort of like upfront about this mock case study of sorts. And let's say we tell you that this company is going for a fundraising next month, and the ask is that all in, they're planning to raise 3 crores at a valuation of 20 crores. So at this point, the total fundraise would be for 3 crores. But as an individual investor, you don't need to put in a check size that huge. You would probably have flexibility to put in anything between, 50,000 to about 50 lakhs to provide like a broad bucket. This could obviously vary on a case by case basis. So now with this sort of like information and context, the question for you would be whether or not would you be willing to invest in a company like Zasket with these sort of specific details. Gaurav, can you share the poll with the group, please?
Yeah. So here is the poll. The question is on the poll window. Maybe Shelfica, we want to go, or Anchal, maybe we want to go a slide or two back, showing either the graph or something else, so that maybe the audience can take that as take a cue from there and then answer the question in the poll window. All right. So anyway, the question is whether you would like to invest in Zasket with whatever we had shown, Shelfica had shown in the previous slides. If yes, then how much? From 10,000 to a lakh, 1 lakh to 5 lakhs, 5 to 50, and 50 to 2 CR. What we will do, and this is a real life case. This is an actual startup, which is where Sparklehood is actually assisting them. And what happened to the startup is also something which we will tell you in the next slide. So we've got about 76% of you who have voted.
Neeraj, you can skip the second question in case you are, all those people who are saying no need not comment on the second question.
Yeah.
Is it so?
No, there are persons who have answered as no as well. All right. I think we've got about 2 minutes.
Okay. In that case, what is happening is that we cannot submit the answer if you do not put in the second question also, the reply to the second question also.
Okay. I understand.
Okay.
Anyway, we'll just close it for now and then see broad-based results. 82% of you, most of you would want to invest in Zasket. Most of you would want to invest within 1 to 5 lakh range. And the second best is less than 10 lakhs. And third is 5 to 50. And of course, 5% of you would want to invest more than 50 lakhs as well. Sorry, I did not share the results earlier. I'm sharing the results now just for everyone to have a quick view of what the audience has answered. Okay.
Okay, I will tell Shelfica, I'll tell what happened with Zasket. So what happened was there's this platform called Republic in US. It's an angel investing platform, and Sparklehood has a tie-up with them. So for the ask that you just saw right now, they've actually gotten approval from Republic for the same fundraise, and they are currently in the process of fundraising. Yeah. So if any of you guys actually want to put money in them, you can still participate. All right. Over to you, Shelfica.
Yeah, sure. Thanks, Anchal. Well, great. So I think hopefully this was helpful in sort of giving you a sense of what the business evaluation process looks like from maybe a bird's eye view, but wanted to give that flavor to you. Next, I think one other quick exercise that we can do is also more of an introspective exercise, basically helping you understand what sort of an investor you are. So as someone who might potentially be new to angel investing, I think it's difficult to sort of understand what sort of companies or what sort of risk profile would work best for you. So basically just want to guide you in terms of what sort of questions you should be asking to yourself. In terms of understanding what investments would be a good fit for you. So here are some of the questions. We'll also open up the polls for some of these. The first question that you should be asking is basically, why do you want to invest, or why do you want to become an angel investor? Is the sole incentive just to get economic returns or like a strong economic upside, or is it also some sort of a hedonic reason to be excited about part of innovation or like helping build a new business? Or is it more altruistic or social, that I want to help other people, I want to help the society, I want to help my community? So what is the key reason behind that investment? And then also maybe think about what's your risk appetite. Maybe like think of it consciously and answer it to yourself, so that if at some point you come across a medium risk opportunity or even a low risk opportunity, you know that, okay, this is a good fit for me because I think I love to take risk. I'm risk agnostic or risk averse, or I don't like taking risk at all. So basically answer these questions to get a better sense of what your incentives behind investing are and what your risk appetite looks like. And these answers could also help you pick the right startup. So let's say if you've picked love to help people or for an altruistic cause, basically you can also try and focus towards more social startups or impact funds, or focused on ed tech startups or health tech startups, basically helping you with finding the right themes of investment as well.
Yep. I think you'll have to answer both the questions and then only you could submit. Got about 80% of you who have answered, and let me end the poll and share the results. So it's playing to the theme. 70% of you do want a return on investment, and most of you would like to take risk. And a few of you are excited, and you would the reason you would want to invest is excitement for innovation. And about 40% of you are indifferent to risk. Very few of you would want to help people or a cause that you believe in. So I'll stop sharing.
Great. Some other questions maybe around the same theme to sort of move on and help you better understand investor. Next, please.
So another question on how actively involved would you like to be post investment? So once you invest in a startup, would you really want to be hands-on, or just maybe support with your network and stay hands-off, or what would be your and what would be your investment preferences? You would want to maybe say only look at a sector or a tech type of companies, or you're open to all kind of sectors as such?
Again, things like these sort of help out when you can think which are the industries where you can leverage your network. There might be certain segments where you feel you're very well connected and can help the team with warm introductions to vendors or to potential clients or customers. So thinking actively about what are some of those sectors that I'm more aware about or would be more interested in, and even thinking of the method of investing. Would you be more excited to look at opportunities where you could basically just put in your capital and be a passive investor, or ones where you come in some sort of a shareholder meeting or some sort of a recurring sync, or are in touch with the management. So basically something to think about in terms of how actively involved or hands-on would you like to be post investment.
All right, let me end the poll and share the results. So most of you are agnostic of the sector. You would want to evaluate at least startups from all the sectors, and most of you would want to be hands-on investor. You would like to be involved in a day-to-day kind of functioning. Yeah, I think that's the typical general theme which is coming out of this, and you would have time. I mean, a lot of you hopefully who are still sailing, who are settled ashore, you may not have time to be hands-on, but other folks who are sailing, they would probably get time to be hands-on. Yep,
Great. Probably the last question now, maybe some of the earlier points and some of the things covered by Saurabh and Anshul might also help you answer this. So just think about, okay, where do you stand today in terms of your profile as an investor? Do you think you are, already an existing angel investor, or you're very familiar with the types of startups and what sort of check size do you want to invest in? Or it's like, I understand the space more broadly, but I need to learn more about the steps I need to take to become an angel investor. Or you're fairly novice angel investor, you understand a little bit, maybe things from today's presentation and a little bit from outside from your network, but you do have a lot of questions that are yet to be answered. Or the fourth, where you feel like, okay, this is not for me, this is not the kind of risk return portfolio that works sort of well for me, or I don't have the appetite for these sort of investments. So just sort of think about where you potentially stand amongst these four buckets.
and I think your answers from the previous four questions is what you should take a cue from, which will essentially help you in answering this question as well. Yep. Another 10 seconds. Look forward to a few more answers, please. Okay. I'm ending the poll and sharing results. So, yep, and most of us are novice angel investors. You understand a bit, but you have a lot of questions, and so you are at the right place. That's what Sparklehood would help you in having better understanding and to answer a lot of your questions as well.
Yeah, absolutely. I think hopefully, some of these questions were helpful in terms of helping you understand where you fit in the broader spectrum of angel investors, and how an exercise like this could potentially help you get more exposure to such investments. I can hand it over to Anshul now, who can walk you through the upcoming course or workshop on angel investing and how it could potentially be helpful for some of you.
All right. So
over to you, Anshul.
Yeah, thank you, Shelfica. So today, I mean, you're getting like a brief glimpse of what angel investing is, what the startup ecosystem is, how exactly it works, what are different stakeholders, what are a few things you need to consider or be aware of. But honestly, I mean, it's 90 minutes is too short a time to cover all of it. So the idea was that today, at least You get to understand what you know and a sense of what you don't know. And that is what we have tried to establish so far. So we'll be doing a series where we'll be doing 6 classes, each of 90 minutes. Every week, there will be 2 classes every Tuesday and Friday, starting 25th May at 7 p.m. So 7 to 8:30, basically, right? And what topics will be covered? 1 second. Yeah. So first was, how do you form your investment thesis, right? So you'll be given reading assignments. You will be actually made to do like make your own investment thesis, and what like some of the standard investment thesis looks like. How do different VCs or angels currently make their own investment thesis? So you will get a detailed glimpse into that. I mean, we don't think you will become an expert because these things generally take a long time, but we do think that it will give you much stronger understanding and flavor of it. Then depending on which sectors, what are like some of the common business metrics and benchmarks and different valuation methods that are used. I don't know why it skips. Yeah. How do you screen the once you have established, okay, this is my broad investment thesis or memo, and which are the basic metrics and valuation methods that currently work? How do you then use that knowledge kind of practically, similar to like the exercise we did with Zasket? You do more exercises across different spaces to understand how you put that knowledge, what you have learned, into actually screening new deal opportunities, and what are like different ways you can also have access to good quality deal flow. A lot of startup investing is not just about investing money. It's also having access to good quality, high quality startups. And a lot of platforms that are there, like a lot of time is spent in just like going through thousands and thousands of applications and screening to bring out like some of the top good quality startups outside from there. Due diligence basically is, I mean, okay, like you have looked at all the claims that the founder is making, but what do I actually need to verify? Like, how do I verify the financials? How do I verify whatever market size they are saying? How do I verify that whatever customer segment or gap they're trying to address, they'll be able to address? So a way or a process to kind of like address these things. The product, have they taken any past financing? The team, are there any regulatory aspects, intellectual property? And then we have Captain Sharma with us, who will be taking the 5th lecture. It'll be actually actual IIM Ahmedabad real case study, which will give you a sense and flavor of how exits happen, because exits are a big thing for an angel investor. So some of the examples Saurabh gave initially, like the M&A or acquisition or IPO event, but so those are some of the typical term that is used as liquidity event. But for an angel investor, sometimes the liquidity event can happen much earlier also, when like a big institutional private player like a VC or a private equity comes in at a series A, series, anything post series B onwards generally could also be a typical liquidity event for angels. And I think I forgot to cover before, like there are different kind of instruments through which investments happen. There is something called SAFE, simple agreement for future equity, or you directly get on the cap table right now. So we'll be covering those also in the previous lectures. And then how do you, after you have like your whole investment thesis and kind of like getting the word out, or it's sometimes in like really high quality startups, founders also make a conscious choice that, okay, do I want to take money from this person or not? Like, is it just capital, or am I getting something else also? So how do you like brand yourself around that? So this we'll be doing like a live one-on-one session with you guys, or we might do like a, depending on the pairing, how is the enthusiasm from the group, how many people sign up, depending on that, we'll either do a one-on-one or two-on-one, something like that. Sorry, there is I think some internet issue. Okay, we'll have few very reputed guest speakers. Nikhil Inani, who was previously co-founder of Farmizi, which is currently valued at $1 billion plus. Anurag Jain, Milk Basket, I think they raised around $40-50 million. They got acquired by Reliance in January or February this year. Vineet Saxena, who was co-founder of Myntra, sold it to Flipkart for 300 million. So some of these guys will be coming for some of the lectures, and they'll be sharing their own personal experiences as an entrepreneur and as an angel investor, what things you should consider, how kind of like good startups are built. So some inside juice and story, which gives like practical insights. So they'll be coming with us in some of these lectures. Okay, so it will be a course certificate. Total 9 hours because there are 6 lectures. Investor checklist, a lot of case studies, assignments, do's and don'ts, healthy, good practical practices, one-on-one sessions for the branding thing. And from our Sparklehood side, we constantly do a lot of screening. So for next 2 years, you will have access to quality deal flow, and we do our own due diligence and shortlisting from amongst all of these startups. So that will be there. For folks who register by 16th May, the cost will be roughly 25K. Gaurav will be sharing the payment link with everyone, I think post the session. And after 16th May, it will be 30K, right? This is inclusive of GST. And so we hope that there's a really enthusiastic turnover from you guys. Even if some of you who won't end up becoming active angel investing, we still think it will be a very, very valuable course for you. And you should have a very good understanding of how to evaluate businesses, even from the perspective of value investing. Right, I will hand it over to Captain Sharma now.
Yeah, thanks very much, Anshul. Yeah, you can. Do you want to keep the screen on? Well, that's fine. I think it's okay. So
Maybe we can stop sharing.
yeah, I suppose. Yeah. So first thing is good afternoon to all those who are tuned in right now, and probably wondering what this old guy is doing out there in this bunch of young, energetic people, and that is the reason which the old guy had actually taken off his video and put a young photo, so maybe he could fit into this kind of group. Yeah. And I also say a special hello to some of the participants who I know personally, and I'm pleased to see them there. So it's hello to Kamal, to Nilesh, to Puneet, to Chandarva, to Gulred, a couple of others. I hope you're still there. And probably you have the same question in your mind. So, what is a ex-mariner come kind of academic guy doing here? So let me explain. I'm, of course, nowhere in the league of investors or financial wizards that can advise you, but I have been given a role in this 6-session course, as you just heard Anchal say. The 5th session is on a case study, which I have happened to be as a co-writer, and that case study is used in the IIM Ahmedabad in our management programs. So this case study is about, of course, an acquisition, and it's a very big company, a $400 million company, which is up for acquisition. And case study is all about figuring it out, whether it's a good investment or not if you were to buy it. but that's the end result. I mean, the starting point would be, from the management education point of view. And as most mariners, me included, we never had the benefit of formal management education all through our growing years, And now that we have come into a bit of funds, should I say, and we want to invest them, we would go by whatever facts and figures are presented by the sort of company that is eyeing our funds, and we may not know how to read those figures even. So that also, in some way, you can call it is a financial management as a subject, is a managerial subject. So in that some way, in these first 3 or 4 sessions, which Saurabh and Anchal and Shelfica will take, you will get exposure to that. And through that case study, when we come to the 5th session, we will be able to apply those concepts into studying a company's financial details. At the very basic level, financial management is about understanding financial statements. It's about knowing what accounting systems are being used. Because when you see the financial statements, and good, smart accountants can turn around a company, to make it look very good just on the numbers. So you got to have a deeper insight into how those numbers were arrived at and so on, So that's at the basic level. At the second level, you may think of how to carry out an investment analysis. So then, what are the formulae that are applied? What are the concepts that are proven, or at least, what are the projections one can make that if I invest here, what would be the internal rate of return, and, what would be the net present value of the company in so many years, and so on. There are some aspects to that. And at the third level, it's understanding the financial risk aspects of it. So at the 3 levels of financial management, the accounting and financial statements, the investment analysis, and at the third level, understanding the financial risks. So we are not going to do that in this course of 9 sessions, 6 sessions, but at least we'll be touching upon many aspects of that. And hopefully then that case study will make sense to you. I know it's about acquisition, and it's if you look at acquisitions as an exit strategy, what was being mentioned earlier, for investors, at the very first level would be the pre-seed, as you talked about, and then comes the angels, and then comes the VCs, and after VCs come the private equities who actually buy out a company, but they don't, of course, run it. They just own it. And ultimately, the last stop for a company is to be acquired by some other company. That means some other party will run your company, and they've bought you out lock, stock, and barrel. So that's the acquisition aspect. But we still call it M&A, merger and acquisition. Although it's not a merger, it's an acquisition. Mergers don't happen today that much anymore. They used to, but now with more and more of, you could say, regulatory aspects coming in, antitrust laws, you can't cartelize, you can't join hands with other companies and, set up some kind of cartel situation. So there are a lot of laws in every country regarding what we call anti-competition. So mergers are losing their shine. It's more acquisitions nowadays. But we still call it M&A because just to soften the blow for the guys who are being bought out. They don't like to be told that, hey, we are buying you out now. So, you still have to work. So to keep the spirits up and, the morale, etc., we still call it, we are merged. Anyhow, so at the acquisition level is the last. And obviously that ties up with a lot other aspects like your own company strategy, which is acquiring company, what will we do with this company that we want to acquire, etc., etc. So that's what we will go into in the case study, and working backwards from there, reverse engineering in a way, you could get a very good sense of evaluation of a company in which one would want to invest. Agreed that startups will not give you that much kind of detail in terms of figures, and it will be a lot more projections. But just for one example, I mean, in the case study which Shelfica did, and you all answered those questions about, wanting to invest. But there was a key issue which you didn't, that information you didn't get. You got information that they are raising what, 10.5 lakh sales, right, Shilpika? How much is that? 10.5 lakh sales in the month of
April.
in the year. But what is the figure that would really interest me if I was an investor? Would it be revenue or it's something else? I'm asking the audience, not Shilpika. Yeah, right. Kunal's smart guy. He said, I want to know what the profits are. So what's the bottom line, as we call it in our financial business? Profit after tax. Yeah, fine, good. So that cash flow, theek hai, not so, yeah, it's important. P&L statement, well, basically you are saying, I want to know the bottom line. So top line is good. I need to see how the top line is increasing, but I also want to know the bottom line. Ultimately, the company has to survive. They cannot keep, drowning in debt all the time. Yes, Munafa, that's right, Neeraj. Okay, great. Great. So, I mean, that's just a drop in the ocean kind of thing, what you need to know about companies before you invest. So that was one example, I thought. And on the other side, as an angel investor, I think some of the questions you answered was that you want to be involved on a day-to-day basis if you are investing in a startup. Then I got to tell you, angel investors don't normally get involved on a day-to-day basis. They are pretty much hands-off. However, if there's another interesting question which many of you didn't answer, in a positive way, is that do you believe in the cause? So if you want to invest in a startup which interests you, which you can connect with your own personal philosophy, that's the best thing. Because if you believe in the cause, then you'll be a lot more confident about going into it. So you think it really will help the general public, that problem that has to be solved, which was initially the problem statement we talked about. So if you are able to hit upon that connection between your own thinking and what the startup is offering, that's the best connect. But also you got to think about the next question: how long you would be in the investment. So what is your exit period? That question was not asked, but you may think: are you expecting to go 2 years, 3 years, 5 years, 7 years? When will that IPO happen? When will that exit event take place? You got to think about those as well. Yeah, so that's about it from my side when it comes to the program that is being offered. My comment on it is that whether it is going to be, in angel investment is going to be your game or not, it doesn't matter. As long as there is some investment plans that you have, one aspect that you are going to kind of engage in if you enroll is risk management. So what you're going to do is you're going to invest in your own risk mitigation by acquiring more knowledge about financial matters. Is something which seafarers desperately lack. I've had experiences. There is a guy staying in my building upstairs on the 6th floor who has spent all his money when he came ashore. He invested in a factory 3 years back. He's out sailing again with zero balance. Those kind of things. So seafarers have that unfortunate tendency to go bankrupt and then go back to sea, of course. But no, don't have such a bleak attitude towards that. If you do invest, it's going to be one way of mitigating the risks that we all face, on the financial side. So with these comments, it's done from me. It's back to you, Gaurav. Okay, thank you.
Right, sir. Thanks a lot for agreeing to participate in one of the sessions in the coming series, and it'll be great to have that with you. So we'll open the forum up for Q&As Neeraj, your question, if you could kindly put it in the Q&A. So anyone who has a question, please put it in your in the Q&A button. You can put it over there. Before you put your question, kindly see if a similar question has come up. If it has, you don't have to rewrite it. You can just put a thumbs up or maybe put another comment on it, so we can take another version or maybe a follow-up comment of that question as well. So that's my request to all of you. A few questions have also been answered, and we've written it down, and so maybe you could go to the answer section and see answers of a few of the questions. I'll hand it over to you, Anchal, to moderate this.
Sure. Thank you, Gaurav. Okay, so we start from the ones at the top. Can we skip the classes and directly get access to the startups? Give us some time to think about it. I mean, of course, startups can use all the angels as possible, but I mean, if you feel that you are completely ready to make the decisions, write to us at team at Sparklehood, and we'll talk to you, I guess, at an individual on an individual basis and decide. How to participate as an individual investor for investing smaller amounts. I think a similar kind of question, Surya Pratap Singh, is okay, same person.
So here I would like to add is that in the proposal, what we are doing is that what we are saying is that apart, in addition to the sessions where we teach you about how and what all things to look at into the investment, what we are offering is that for next 2 years, approximately 240 startups is what we do is that we market or raise funds for on an average 10 startups every month. So in the 2-year period, that is 240 startups. So you get an access to invest in these startups for free of cost. As in all these emails, whenever we reach out to our exclusive angel investors, you are a part of that exclusive group and you get an access to all those startups who are looking for these funds. And these startups are specifically, primarily, there was also one question which somebody had asked, is that what is the difference between us and companies like venture capitalists? So the primary difference is that we act more as a mentor. So any startup for whom we are raising fund, we know them, we have been knowing them since last 4 to 6 months, and thereafter they are raising fund. Whereas what does venture catalyst or similar syndicate groups do is that you can reach out to any startup, can reach out to them, and it's just a transactional activity where they reach out to their investors for raising the fund. And the difference lies is that the mentorship we provide. So you by default get an access to these 240 startups, which would be on an average, we select one startup out of 100 startups which come to us. So approximately 24,000 startups in the Indian ecosystem during this period who have reached out to us. Out of that, we select those 240 startups which we reach out to you.
Okay, thank you, Saurabh. So we move to the next question. For how much time I have to keep my money invested? I think Captain Sharma also did address it indirectly that, okay, this is an important question. You need to think about it in some ways. It would, so the real answer is actually, it depends when exactly the liquidity event for the company will happen. And liquidity event for angel investors typically will happen series B onwards. So most of the angels will get their exit from anywhere between series B to E, unless you really want to sort of like continue to be on board.
So in
I
terms
hope
of
that
time,
answers.
it would mean somewhere around 5 to 6 years horizon before
I
any
would
liquidity.
say maybe even it could start 3 year onwards. On the lower side, I think it would be 3. On the upper extremity, it could go to 7, maybe. Neeraj Kumar, I want to know if I will get all the information of the startup. If, so I'm guessing, Neeraj, you're asking this, if you will get information of the startup to evaluate the startup from an investment point of view. Yes, of course. I mean, it's the founder's responsibility to provide all the information that he requests for. The only sort of con here is that if a founder is dealing with multiple angel investors, sometimes for the founder it gets extremely time consuming to be addressing the Q&A of each and every investor on a regular basis. So this would happen typically when like there is extreme level of seriousness from your side and it is at a due diligence level. But generally angel investors do not do it at their own level. Like someone like a venture catalyst or Sparklehood could provide this information for you, but individual investors actually don't do the final due diligence, because also it's a lot of effort and work to go and verify all of these things.
He is not asking in terms of due diligence. His primary question is whether to evaluate whether I'll get all the information which I seek for the particular startup.
Yes, that of course you will get the information, whatever you think is necessary for you to form your opinion on it. There could be certain kind of financials which a more mature company might have and a startup might not have. So if they don't have it, they can't share it. Yeah, moving on. Karan, I'm a sailing staff and don't have immense knowledge about business. How will I come to know? Wait, I think, how will I come to know that particular startup is good to invest? Um, do you want to take that sort of?
Yeah, that is what the session is all about, where we primarily tell you about what all things which you should look at to decide whether this investment makes sense. Apart from that, I'll say that it doesn't matter if you're sailing, because you don't have to deal with the day-to-day activities. And anyways, on a quarterly basis, the startups whomsoever you have invested in, or monthly basis, we decide upon a pattern, and then the startup keeps updating the investors about what is the progress, what is the status, what are the primary challenges which they are facing, and any kind of investor support which they need from investors in terms of maybe warm introduction, maybe in terms of hiring or any these kind of things. So I think that will give you enough idea to decide upon the investment.
What is the, I think, Shelfica, are you taking that? What is the approximate profit percent I can expect from one investment?
Yeah, I was just about to type that out. So it would it would vary a lot on a case-by-case basis, like Saurabh had covered towards the beginning of the presentation. On a successful exit, you can expect like a 5 to 10x exit on a good startup as well. But there could also be other cases where the business did not perform well. So yeah, I mean the upside case, and Anshul Saurabh let me know if I'm missing something here, but a good ballpark would be like a 5 to 10x exit on a successful startup.
I'll take I'll take it in two. When means I'm not sure what do you mean by profit. If one thing to clarify is that for the capital investment, we are not here talking about the profit sharing, as in if the company makes a profit of let's say 10% or 10 lakh, that profit is not shared with the shareholders or the people who invest in the company. Right, what you primarily get for your investment is a shareholding. So, and the idea is that somebody else buys out, either takes your share at a higher price and so you get a return out of it, or maybe the company gets listed at a multiple X, and again in that case you can get the return by selling your shares. In either of these cases, the rare cases, exceptional cases are where you make 100x or 1000x. The usual 10x is the, if the startup performs well, In the worst case scenario, the risk is that you don't get anything because the startup ultimately closes down.
Okay, Kunal Amrute, I won't be able to track it all the time, so Sparklehood can do it. It's actually, I mean, it's from a practical perspective, it's very difficult for individual angels to actually, on a regular basis, keep track of everything. Founders will send you certain updates from your side, but it's easier for a platform to kind of keep track of these things and ensure that the paperwork and everything gets done, and if there is any liquidity event, following up, kind of being there to ensure that all of these things happen according to the process. I hope it answers your question, Kunal. How is the startup business going on in this pandemic scenario? I think depends on, again, what kind of startup you are. I mean, if you are a very hardcore technology company, which is in some ways helping the world function during the pandemic, then you're actually seeing growth. But for a lot of other companies, there is, of course, momentary slowdown, right? Kamal, during being on board in a company, would the angel investor get any payout in terms of dividends? I think Saurav has already covered this, right? Saurav, do you want to add anything or we move? Okay, we move on. Is this angel investing similar to investing into stocks of unlisted companies? Primarily, one is putting money into equity.
Exactly.
Yeah, you are right. Exactly. It is exactly that. It's just that unlisted companies could be of any kind. In a startup, generally you think that, okay, they are solving the problem based on some unique insight or from an interesting angle. Sorry, Saurabh, please.
Yeah, that's what it is. And the expectation is obviously one of the expectations is that you get a multiple return, a much higher return because the risks are equally high.
Yeah. Okay, Shantanu, for startups like the NSE website for stocks, where can we know about the financial health there? It's a private company. Private companies are not regulated like a public company to be declaring all of these information. So founders will send you some details about any major milestone or growth or traction, maybe on a quarterly basis. Some founders even do it on a monthly basis. But like an audited statement, that will be just something I think a typical CEO or something will share at the end of the month.
It is available if it's a because it's a private limited company and is registered in ROC. Specifically, we are talking in the Indian context. So there are websites like Toffler and similar who can provide you annual statements, but for that you have to take a membership. It costs you around 250 to 300 or 500 bucks. By paying that amount, you can download the annual report of that particular company. But in case you are an investor, you don't need to do that. But because anyways, the founders will be sharing the performance of the company on a quarterly basis or a monthly basis.
Okay. Tarun Bellam, how are the valuations of the startup determined for angel investor and by whom? Broad answer to this is that the founder generally understands the business or the requirement of the business much better than everyone else, and they know what evidence they have to kind of back up whatever growth they have shown or traction, and depending on all of these things, what plans they have to grow the business, what resources they need. It's a combination of these things that kind of decides what the founder is asking for the company. The money will be used for the growth in general, so that kind of founder also takes care of the things that, okay, if there are multiple rounds of funding happening after this, there will be dilution also at every level, right? So, and the goal, or even an angel who comes at an early stage, eventually for them to get an exit, it has to continue to keep growing at all the levels. So a valuation a lot of times it just at the initial stages gets decided by the founder because he's making a ask that I think I need this much money at this much valuation to kind of like allow the company to grow in a healthy manner. That is a very broad answer, I know, but there is no mathematical formula which exists to decide this valuation. If you want to know that, Saurabh, do you want to add anything to it?
Maybe. So what I'll say is that if we talk in terms of economics, and as Sir would suggest, that the cash flow analysis does discounted cash flow analysis or something like that, which gives an exact value, is not available obviously for the startup because they are at the two initial stages. What is available might be in the market is reference levels, as in, let's say, a company in a similar space which is a competitor got raised certain amount at this particular valuation. So that gives you a kind of benchmark that where does this stand, and you can always compare the startup in which you want to invest with respect to that, that whether what are the other variables affecting, how is the founder comparison, as in are these founders more have more strength in terms of the industry knowledge or from that particular market, or their approach is slightly different than how the reference company was operating. So that can be possible to a certain extent. As a benchmark, we do need to understand is that any particular at any particular round when the fund is being raised, on an average, the dilution happens between 15 to 20% for a company. That is the usual. And what, as an investor, what we need to focus upon is that whatever milestone the company is looking to achieve by raising this amount, whether the amount which they are raising is sufficient enough to reach that particular goal. So rather than questioning about what is the valuation, the investor's focus should be on what is it that the company is trying to achieve, what is the amount which they are raising, will that particular amount help them to achieve that particular milestone. And if that works out, then the dilution negotiation happens between 15 to 20%. So that is how the value is approximately arrived. There are no fixed calculation, as exactly Anchal said.
Okay, Puneet, yes, any shareholding or investment that you do, there will be legal document for that. There are different instruments, but I don't think it makes sense to go into that right now.
Yes, but it is an absolute legal document. There are clear-cut, defined rights which you have as a shareholder.
Yeah, okay. Satyapal, what is the procedure or on what basis Sparklehood choose for fundraising for startups? So there are two things that we do. One is initially when we choose the startups, we are coming in at a much early stage before even an investor can invest into the startup. So at that time, we're looking for broadly founder market fit because we're working with working professionals, a slightly more mature crowd who has a good understanding, domain knowledge, and experience in a particular niche that he or she is trying to solve. Plus, at early stages for a startup to prove their traction, if they're trying to build something around a network or a community that they have, it's easier for them to validate their thesis. If it's a tech guy, then someone who has built few products in the past, so that is an evidence that they can build again. So these are some of the things which we look for initially when we are trying to filter the founders. After that, once they come inside for the first 3 months, there is a lot of regular hand-holding and mentoring that is happening, and then at the end of 3 months, our own committee internally decides, okay, if we want to continue working with the startup, have they shown strong growth, is the founder like really committed, should we continue to work with them? Then past that 3 months, if we continue to work with them again, I mean, the mentor, us coaches, the Sparklehood board, all of us, once we feel that the startup is actually completely ready to raise fund, then only it goes to the investors. Otherwise, there are a couple of startups even now in the cohort who are past this 3 months. The founder is really amazing, but he keeps pivoting, right? But he's an extremely smart guy. We believe in him, but he's not ready for fundraising yet. So we won't introduce him to investors right now. I hope that answers your question. Okay, next one. What if the idea is more involving into innovative things happening around and mentoring or giving your part of expertise and then think of investment? I'm not sure I understand the question. If anyone else wants to take this.
I think what he's trying to say is that if the means primarily what he is looking at is that before investing, he wants to mentor the startup and provide that support before he did, and maybe know the investor, the founders for a longer period of time before he thinks of agreeing to invest into that startup.
This will be a conversation between you and the founder. If the founder is convinced and he thinks that whatever they're trying to solve, you can actually mentor him. You have the right expertise and the experience, and you can make the right connect, and founder that feels value in it, they will continue to invest time with you and continue to interact. That happens all the time.
Yeah, to further add, what I'll say is that it particularly the startups which we deal with and the Sparklehood context specifically, when we start a fundraising for any particular startup, it is a time bound event. We do not keep it endlessly open. So the like let's say 15 days or 1 month at max, this is the period where we allow the investors or to discuss with the founders, decide upon whether they want to make an investment, yes or no, and we actually close the round. So here you have a time period of around 1 month to make your decision. You may discuss with the founders whatever you want to, and we can always coordinate a call regarding that. The your support, if you decide to invest based on the interactions which happen, if you thereafter your coordination or your mentoring with the startup founder is totally between you and the founder specifically, and we do not play any particular role in that part.
Okay. Himanshu, can you please clarify difference between a venture and a startup? I actually don't understand what exactly do you mean by venture. Do you mean like a typical business? I would maybe focus more on startup, that why a startup would, let's say, be a different from a typical business. Here there is just like a huge focus on solving the problem in some unique manner, where you see that there is huge upside, or you're solving the problem in a way that it adds some kind of huge advantage either in the costing, or the model is really scalable, or the distribution cost is really less. These are some of the ways a typical venture would differentiate themselves as a startup.
Maybe I can further what to maybe put another perspective is from the investor's perspective. I'm assuming what exactly Anchal said, that venture is a typical business and we are differentiating with the startup. So from the investor's perspective, a typical venture or business doesn't make sense because they are not here to earn profits from the operations of the business. Their idea is to make outsized return from any particular investment which they make. And for that, the prerequisites are kind of factors like whether the startup is able to grow 10x year on year basis. This is one of the typical primary focus which any venture looks, any investor looks at, that the startup should be able to grow tremendously so that they ultimately make a huge return on their particular investments. They do not have any objective of making margins from the profit which the startup operates.
Yeah, if I could add, when we are talking about a typical business, there are possible 5, 7, 10 years before even the bottom line turns black. Otherwise, it may remain red for a long, long time. So investing into a business in long term, there could be a lot of capital expenses involved, etc., etc. It takes time for the business to establish and start generating profits. It doesn't happen overnight. In startups, it's a different scene, I guess. You are looking for faster returns in that sense. But of course, it's not on the profits alone. It's obviously on the, as you said, liquidation event that will take place. Okay.
Yeah. Okay. I'm sailing most of the time. I would be putting my money for, I don't know if this is a question. Next one. How can we be sure on the absence of conflict of interest between the startup and the investment house? It would be easier to answer this question if it was asked with some form of explanation, but let me try to answer it. Typically, investment house, the way, so if you're saying an investment house, I'm assuming it's a VC firm or a PE firm. So generally, a VC firm or a PE firm, they have their own thesis according to which they invest, and when they bet on a startup to solve a certain kind of problem, once they have made their bet, they are anyways not going to invest into another startup which will have a conflict of interest because it's within their own portfolio. I don't know if I'm interpreting the question wrong.
I think I'll request Rajendra to maybe put a top up to it, because I think that will probably give a better context to answer for us to answer. Oh, okay, he's written it in the chat. Okay, no, that's something else.
Okay, maybe if he replies again, we take that question.
Okay, cool. How can we be sure on conflict of interest?
One question is left, Sake. If the startup is not progressing as expected, is there a possibility to withdraw our investment? So the answer is no, Sake. Once you make an investment, you cannot withdraw that investment from the startup. So that is the risk which we as investors carry when we invest into a startup.
Okay. If I have an idea for which investment I need, will this course help to know how to raise capital? This is not a course for you to raise funds.
But I'll say this course will help you in understanding the investor's perspective, as in what are the things which investors look when any company approaches them for raising funds. So if that makes sense to you, then this course is for you.
Okay, Bhupender, we have a 1% selection rate, and what is your USP? I think I've already highlighted these in other ways. When we are initially doing the whole selection or the filtering, we are looking for founders who are really mature. There is a strong founder market fit, because a lot of times when not all the startups, some of the startups who come into the cohort, they already have revenue also. Some of the startups who come in, they barely come in with like a one-page idea. So there is nothing to evaluate. All you can try to see is how smart the founder is, how many questions can you keep asking him from multiple different angles, try to blow hole in all of his ideas and see how thoroughly he has thought through. That's all you have at that stage. And anyways, they don't come to the investors with just an idea. With you, when they come, they will be past all of that stage. There'll be a product, there'll be some evidence whether it's working or not. So I hope that answers the question. Yes. Are you charging for mentoring the startups? We do charge something for mentoring the startups, because the mentors we have on board, a lot of them, on an average, their startups are valued at somewhere between 150 to 200 million, and all of these guys are extremely busy. these people, if they are giving their time, I mean, we have a different structure internally. I won't go into the detail of that, but we do charge because we do give some money to these people, because I mean, you can give advice to people once for free, but you won't do it on a regular, consistent manner. So that's why we charge. Okay.
Right, and in addition to that, we also run the mentoring sessions where we teach about different topics to these startups, like maybe SEO marketing, maybe about growth, maybe about what are the different pricing strategies, or so on and so forth. So all these topics, we bring people from the industry, from different startups who have actually done that and who have actually faced that part or that challenge. So all these people do come at a cost. So that is also one of the reasons why we do charge.
Okay. Do founder come for presentation session and question answer before asking? Yes, they do. There will be, yes, there will be a Q&A. Like generally it will be in a format where multiple investors will together attend a session with the founder to ask questions. And it's actually beneficial for the investors also, because then other investors ask questions from different angles, which you might not have considered. So it helps you.
So it's very much in the similar format, like what we are doing here right now, the presentation and thereafter the Q&A session.
Okay. Last question, what is procedure of registering a startup with Sparklehood? You can apply on our website. There is a form you can apply. What exactly would you be sharing with us about those 240 startups? How would that assist us? It's to, okay, so to invest in stocks, you need to go to a stock market to find the stocks from where you can invest, right? So to invest in startups, you need a deal flow of good quality startups. It's just that.
And we share when we are saying about 240 startups in next 2 years, what basically what we are saying is that you will be the kind of first set of few people who will know that this company is looking to raise fund, and you will get all the details about that particular startup to decide upon whether you want to invest in that startup or not.
Yeah, I think that covers it. Cool. So no more questions. Gaurav,
Yep.
over to you.
All right. Hey,
I
thanks.
think we missed
Thanks. Yep. Go
one
ahead.
question, whether Sparklehood invests in startups. So we do not make an investment into the startup. So in that particular way, there is no conflict of interest. We do not make an investment into the startup.
We do have a plan to open our own VC fund in future, but it's currently a work in progress.
So if you will allow one question, guys, among the startups that we see these days, what particular sectors are kind of more popular, like edutech maybe, or does it stand anywhere? No, the Baiju ripoffs.
Obviously, EduTech is flavor of the season right now.
Okay, yeah.
So anything you would want to add to that particularly, Anshul?
No, I was just saying edtech, I think last year was extremely hot. Now I think with the second wave, it sort of again started becoming hot. In between, I think it had cooled down a little bit. Now, for example, not exactly in India, but NFT, let's say, is very hot globally. Non-fungible tokens where you can have ownership of digital assets. So in investment community, that does happen from time to time. Certain sectors or theme tend to become hot. It's a function of, I think, macro market factors.
All right, guys. Thanks so much. We spent about 2 hours and a fairly good detailed presentation, and all questions explained in a very comprehensive manner. So thanks, Anshul, Saurabh, Captain Sharma, and Shelfica for your time. Answered all the questions. Let us take a couple of poll and your feedback, please. So just to check, how many of you, after going through this session, would you be looking to enroll for the course? Yes, you would want to. No, you wouldn't, and maybe you need some more information for which we could probably connect again as well. But so, how many of you? What's your views on for your attendance for the detailed course, please? We'll look forward to a few more answers. All right, got about 85% of you who have answered. Let me end the poll and share results. So about 44% of you need more information. Anshul, Saurabh, is it possible to possibly have a closed group discussion between these 14 persons? Maybe they have more queries which they would want to take one-on-one.
Yeah, sure, that can be done. How, I mean, we'll have to decide like time and when exactly we will.
Yes. So what I'll do is probably someone from my team could reach out to these persons and possibly take a time for tomorrow, if it's okay, to have this discussion. Or we'll discuss. What we'll do is probably we'll discuss. We'll have a WhatsApp group or so, and among all of us, and we'll discuss this. To the persons who would want to enroll, for sure, we have put the link in the chat window. Or no, I sorry, it's not gone. Let me just put it there. So there's a link for payment. The link stands for I mean this amount stands for 24 hours, which is till tomorrow. So please make your payments over there. And for the for those who wouldn't want to, that's absolutely fine. Thanks for your time though. Thanks for coming in. And let me also take a final poll on your feedback, please. And this is very important for us. So you had certain expectations when you came into the session. Were they met, unmet, exceeded? Was the session useful for you? And how would you rate the session? This was one of its kind, essentially. And not many, leave alone our marine ecosystem, any other ecosystem, not many of such sessions happen. Check out with your friends how many of them would know of any company which is giving a deal flow on startups. So this is a fairly novel, new concept, fairly niche. And the access to the deals and this understanding is not very common anywhere as such, especially in India. All right, we will send the link on email as well to everyone. We will send the presentation as well. Okay, got about 80% of you who have answered. Thank you so much for your response. Let me first share the results and any points on improvement, any points where your expectations were not met, where you would want us to maybe add on in the next few sessions, or the next session, which hopefully we'll do after a quarter or maybe once every 4 to 5 months. Do put those comments, expectations down, and we'll try and address them in our next session as such.